It's so interesting to chat with people like yourself who are experts in a field that so many agency owners need help with, which is making more profit and making sure your finances are all organized and in check.
Welcome to the Happy Clients Podcast, brought to you by Dot & Company. Whether you're a virtual assistant, an agency owner, or a client-facing account manager, we all deal with clients. Lucky for you, client management is what we do best. Now, let's dig in, chat cam life, and have some fun along the way. Cheers to happy clients.
Well, Adam, welcome to the show. We're so excited to have you. It's so cool how we got connected through one of our agency partners.
Thanks, Taylor. Thanks, Katie. Thanks for having me. It's a privilege to be here. And yeah, through Todd, we got connected and happy to help where I can.
Amazing. Cool.
I want to dive in for sure. This is my favorite question to ask all sort of entrepreneurs and business owners. Like, how did you get here, Adam? Obviously, you're a different mind than some of our guests we have on. You're heavy into the finances and you're here to talk all the money stuff. So how did you get to where you are today?
Yeah, good question. Thanks, Katie. You could probably hear from my accent. I'm not American, even though I live in America. Originally from Cape Town, South Africa. Grew up just north of that in Pretoria, but then studied in Cape Town. And my wife spent some time in the US in 2014 before we were married. And when we got married, we wanted to do something different. And so we decided to move to the US and do something different. So that's how I physically got to Annapolis, Maryland, where I live. In terms of finance, though, I'm an accountant. It's what I've done my adult life. That's what I studied. It's the first job I ever had. I worked at a law firm out in Cape Town, about 150 people, just as an accountant to start, and pretty quickly found myself in a director of finance role. I had someone who left and was pretty opportunistic. And I just was intrigued by getting to understand how businesses work, kind of from A to Z, not just ticking some debits or credits or whatever it is in the financial world, but actually really seeing what the picture is of a business through the finances and how you can utilize that and how you can understand a business, how you can make decisions that are, not every decision should be financially driven. A lot of decisions should be driven by your own expertise and your own knowledge and your own intuition. But there is this underlying financial piece, which is just so helpful when you're trying to make good decisions. And I got exposed to that world and I found it a lot of fun. And then when I moved to the US, I met some really fun people. I'm sure a lot of people would know who Conversions.ai or Jarvis, the copywriting software. And they were actually our first ever client. They weren't called Jarvis then. They were called Proof Technologies. They actually had a couple of different things before that. They were my first ever client. And I got to know those three founders really well. And they connected myself to a lot of entrepreneurs. And then ABR Consulting turned to Clever Profits, turned to an accounting firm that services 358 businesses. So it's quite fun.
Wow. Amazing. That's so cool. I love hearing that entrepreneur story, and Katie geeks out on it. But it sounds like you kind of just followed your passion and just landed you in a spot that made sense.
Yeah, if you had to say I'm passionate about finance, that's a big statement to make. I would say I'm passionate about entrepreneurship. I'm an entrepreneur like anyone else. I'm preaching to the choir here. I am an entrepreneur. So that's the real passion. And it just was attached that to the thing that I knew the most, and that was finances. And now I have a business. And yes, we may help other entrepreneurs in the financial world, but I'm way more interested in just entrepreneurship, period. Just running a business, which is the fun part. And one of those aspects is finances, which is what we can talk a lot into, but that's just only one of many. Would never advocate that one's more important than the other. They're all, if you want to succeed, you need all the different pieces. They all need to be on the table. You can't just have one or two or three of them. You got to have them all. And so just happy to find myself doing that in the entrepreneurial world, which is fun.
And who is your client, Adam? Like, who is the ideal avatar? Who are you working closely with?
Probably anyone. We have quite a big spectrum. Now we've grown significantly, so we have quite a big spectrum. I would say where we are best suited, we're an accounting firm that are really geared around strategic advisories. We're really trying to help people understand finances and kind of sit in that fractional CFO world. And so our ideal client is a business owner or business owners who have probably 8 to 15 employees / contractors, people that work on their team, making anywhere from $1 million to $3 million a year, give or take. They're just trying to figure this out. They've got a proven product. They've got a proven system. They know that they can help their clients. They know that they are able to run an agency. They know that what they do works. They've got some kind of acquisition machine, and they're really just trying to take this and make it whatever they want to make it, which is hit the stratosphere or just, chug along or whatever it may be. Everyone's different. And I think that's where we fit really well, is we can then sit in that financial seat without having to employ someone full time, but sit in that financial seat, offer that kind of level of insight to then, upskill and help that business grow to the point we aren't obsolete, where they can hire an in-house finance person, which is the goal for everyone. And we advocate for that. We can't service everyone. Apple doesn't have a fractional CFO. So, if you're going to get there, you're going to have a full-time employee. We're just that kind of stepping stone.
I love it. Similar to us, I guess.
I know that's familiar. That's exactly what I was thinking, Taylor. I was like,
So Adam, we want to get into the good stuff and really give our agency audience some key takeaways that they can implement into their agency to help them move the needle, or at least get a really good understanding of their finances. So I'll let you kind of take it away and give us some of your top tips.
No problem. I'm pretty sure most people have read a book like Profit First, which is a great book. Really enjoy Profit First. The kind of bucket system of understanding how to organize and sort your finances first. I read Profit First. I read a couple of other books. One in particular was Simple Numbers, Big Profits from a guy named Greg Crabtree. Profit First is, I would say, very mindset driven more than anything else. And, if you read something like Simple Numbers, Big Profits, Greg Crabtree is very accounting. So it's a lot more technical. And I realized I had a bunch of clients and I didn't even know, and I'm the finance guy, and I'm like, what is good? Where should we be? How much should we be spending there? I'm getting asked these questions and I'm kind of going off, just make sure you don't lose money. I was trying to answer the same question. So as I was reading these books, I realized that what I was looking for was some kind of scorecard that I could look at a business and say, hey, you're doing pretty well, or you're not doing pretty well. And if you are doing well, where are those good areas, or where are the bad areas? What do we need to focus on? How do we actually make some good decisions here? And so took a bunch of our clients, read these books, sat down and tried to figure out a way to do this, and came up with a thing called the perfect P&L, and was born out of reading these books and reading these bucket systems and these things. And Greg Crabtree's book is really, really good. If you don't like finances, I don't recommend you read it, but it's a great book. I'm not knocking the book at all. It's just very technical. And then I remember when I learned how to play chess many, many years ago. Now, one of the things I was taught is where to position your pieces to leverage them the best. And there's a picture of where you can position your pieces to give each one its best opportunity to both defend and attack and whatever. And it's almost impossible to achieve that in a chess game, because you're obviously reacting to someone else. So the likelihood of you getting into that position is almost negligible. But understanding what it looks like helps you make decisions, even if it's not for all 16 pieces to be in that position. Even if it's only one or two, that's where the good decision is. And that's where this perfect P&L concept came up to me. It says, okay, well, it doesn't have to be an exact science, but if we just understand what it could look like in perfection, then we can make good decisions. Whether we ever get there or not is irrelevant. Whether we ever tick all the boxes, if we just have this rubric and this yardstick, we could make some really good decisions. And so that's where the perfect P&L came from. And the perfect P&L is fundamentally built for agency owners, course creators, and some kind of service provider who's selling some kind of digital product. So if you're selling, like a $9.97 ebook or whatever it is, like this will work for you. If you're a manufacturing company, if you're very heavy service-based, like accountants or legal or doctors, doesn't quite work that well. So we've learned as we've grown in scale. SaaS companies, we've had to change the model. E-commerce companies, we had to change the model substantially. But this model was fundamentally built for, actually, agency owners was the number one, and then course creators was the second offshoot of it. And the perfect P&L literally just breaks down where you should be spending your money, and gives you a very easy way to look at it and know, okay, this is good or bad, and now I can go do some work. And the analogy I often use is when you walk into the doctor's office, you don't do an MRI. You walk in and they do some other thing. They check your pulse and your eyeballs, and are they dilating and down your throat, and do all those wonderful things. And they go, okay, well, we now maybe need to do an MRI. And there may be a place in your business you need to do an MRI, but you can't do an MRI every week. You just don't have the capability. You're an entrepreneur. You're trying to do probably 500 different things. Like I've been there. I can't go and do an MRI in my finances for 4 hours every week. It's just not possible. And the aim of this is to give you the like a quick snapshot to then know, okay, maybe next week I need to go do this MRI because that's important. But you can then focus on it and not have to trawl through your entire P&L. Okay, so I'm going to share my screen quickly.
Amazing. We are all ears.
What you firstly want to identify is what drives your business. What are the key drivers in your business? Now, everything that happens in your business, every single activity that happens in your business has a financial ramification. Whether you like it or not, we're running businesses. We're not a nonprofit. We're not playing sport. We're running a business. So everything has a financial ramification. So if I buy, this mouse, has a financial ramification. If I go and try and find a client, it has a financial ramification. So what we want to do is we want to firstly identify what are the key drivers, what actually drives our business forward. And then what are the things that are like, well, we just have to have this. If I don't have the mouse, I can't necessarily do my work. The mouse doesn't determine whether I'm actually going to make more money or not. Getting more clients does, but the first thing we want to do is identify that. So what we did is we said, okay, we can then break down a business. So this is a normal P&L, profit and loss statement, very simply driven, all the income at the top, list of all your expenses, then your profit, then your taxes, then your net profit. Okay, very simple. If you've ever looked at a P&L before, it can be long, it can be cumbersome, it can be this big document with lots of things, normally alphabetically driven, advertising, bank charges, consulting fees, depreciation, whatever that. It's a random list of alphabetical expenses that exist in your world. What we were like, unhelpful. It doesn't help me. What I want to do is I want to identify what are the key drivers, and I want to measure those as often as I can. And we realized what the key drivers were. And the key drivers are client acquisition and fulfillment. If you want to grow and scale your business, it's all about getting clients and delivering your product. I've yet anyone in 5 years to tell me differently, that, oh, this may be something else. And yes, you can break down client acquisition into, it could be paid, it could be organic, it could be referrals, it could be an affiliate thing. Obviously, there's different ways of making that happen. But ultimately, the single most important thing in our business is to get people to say, oh, I like you, here's my credit card or whatever it is, I'm ready to pay you money, let's go. Single most important thing. Without it, you don't have a business, okay? You can try and be efficient, you can try and do whatever you want, there's no money in the system, you're wasting your time. Then how do you keep that money? This is our analogy, is how do you get the money? Well, you find clients. And how do you keep the money is you do a good job. You make sure that you're not a muppet and you don't steal people's money. So you have a good fulfillment arm that goes like, okay, I can deliver a good service. I can do a good job. People like working with us. This can work. That's fulfillment. Fulfillment in our world is all human resources. It's essentially the product we are delivering. Okay, so if you're an agency, it's the people, your account managers, your media buyers, your operational people, whoever they are there to keep the money. They want your clients to stick around, to stay month over month, to offer a good service. And then the overheads are just the mouses of the world, the things that just are there. We need them, range, software, insurance, utilities, all those different things. We need them. I'm not saying they're not important, but they don't drive your business forward. We're not going to turn around and say, hey, let's go and invest a whole bunch of money into new software to grow our business. Probably not. We're going to say, let's go invest money into growing our team, or let's go invest money into getting new clients. Oh, the byproduct of that, you also need to get some more software. Not that it's not important, but it's very much so the follower, not the driver. And so we say, well, just measure those three things. And every day or every week, at minimum, we say every week, measure those three. And if you measure those three, we can then work out whether it's good or not, good or bad. So what we do is we start allocating percentages, the bucket system. This is the profit first bucket system that kicks in now. Okay. We use income as the variable. Now, a lot of people have said to me, like, why do you use income as the variable? Like, surely you should be doing some costing model. So yes, accountant, when you work in the manufacturing world, maybe, but we don't work in the manufacturing world. So there's two different ways to understand pricing. You can do value pricing or you can do cost pricing. Cost pricing is, there's this mouse, Apple goes and, or Apple's mouse is bad to say, there's a pen. This company goes and buys all the parts of the pen. They add a 50% markup and they sell it. That's called cost-based pricing. You work out the costs of everything, you add a markup and you sell the product. We don't want to do cost-based pricing. We definitely don't want to do cost-based pricing in the service-driven world. We want to do value-based pricing because we want to protect how much money we can make. We want to use value-based pricing to say, hey, this is how much value we can offer our clients. And we don't want to be capped by what it costs for us to offer it. That's how we win in entrepreneurship, is we offer the maximum value and then we go work hard to bring our costs down, not the other way around. So we use income as the variable. If you can charge your clients $1,500, $2,000, $2,500 a month, retainers, $5,000, whatever they are, that's great. Let's use that as the variable. That's it. That be the one that we measure everything with. So we make that 100% would be income. And then what we do is we allocate money to the different buckets. We loop together client acquisition and fulfillment from a starting point as the key driver. That's the heartbeat. We call it the golden ratio. There's a little tab called the golden ratio. I'll break it down in a moment. It's the golden ratio. If you had to tell me, Adam, you can only ever measure one number ever again in your life in a business, to be this number. I would take all client acquisition costs, all fulfillment costs. I would want to know what percentage of revenue does that make up. We don't want that to exceed 55%.
So all of your marketing costs, so your people, your online services, or would that be overheads? So like we pay for Calendly, we pay for Zoom.
That's overheads. All that software and stuff, that's overheads.
Okay.
Yeah.
Our marketing costs plus our team costs 55%.
But use the word client acquisition.
Okay.
It makes more sense because marketing can be a little bit one track. Anything that you're investing in to get clients.
Got it.
Yeah, like the marketing is attracting people or the clients.
Well, marketing is one of them, but there could be others. There could be other little things you're doing. Marketing is one of them. I'm not saying marketing's wrong. Just think a little bit broader. Like anything that you are doing to get people to say, hey, here's my money. That's a client acquisition cost. That's a cost that you're going to incur to get people to come pay you money. Take all of those, take all your human resources, lump them together, 55%. I just want to start here, 55%. 15% to overhead, rent, software, insurance, utilities, merchant fees, bank charges, all that other stuff. Okay, that gets you a 30% pre-tax profit margin. It's really healthy. That's a really good profit margin. That's pretty aggressive, actually. Most people average probably around 20. But this is the perfect P&L. It's not the average P&L. It's the perfect P&L. So we aim for perfection. We may not get there, but we're aiming for perfection. Then, factor in some taxes. About 30% of your profits will be taxes, which is effectively around 10% of the top line. And that gets you about a 20% profit margin. Okay. I often say, depending on how big you are as a business, your overheads are a little bit harder to manage. If you're making less than $1 million a year, your overheads will likely be closer to 20% because the economies of scale is a real thing.
Right.
So as you get bigger, normally those costs start to decrease. So that 15% is very much geared around like $1 million a year plus, okay, in top line revenue. So anything less than that, you may struggle to stay at 15% and maybe as high as 20%. Like I said, what are the key drivers? Client acquisition, fulfillment, and we call that the golden ratio. In our world, we say the golden ratio is how much you're spending on those two things. So if someone should turn around to me and say, Adam, I'm trying to grow my business, that's the first place we're going to look. How much more can we expect in client acquisition? How much more can we invest into fulfillment? What does that look like? And the best part about this, you can reverse engineer it. So you could do a cost-based pricing model if you want to. You could take all of your labor costs, all of your fulfillment costs, you could add them all together, divide them by, I'm going to give you a percentage in a moment, and that will give you the target revenue you need to be generating in order to be at the perfect profit margin, which is a great thing. So you can reverse engineer it. It's not just top down. You can look at an individual cost and you can say, well, if I'm going to spend that to do this, I need to then earn X amount of top line revenue. So that's what my goal is. That's what I need to go and gear myself around. Does that make sense?
Totally.
Okay. So the golden ratio is, I call it the engine. Okay. It's the engine of every business. Is your business healthy or not? It's how does your business work? You're going to get this golden ratio right. That's this one over here. That's 55%. So I'm going to give you the quick little overview of the whole thing. But most people here are going to focus on done for you. Done for you being full service agency model. You have a very high team costs, relatively, like high team costs because that's what your model is. You're doing all the work. You normally have longer term engagements, normally quite a high lifetime value of a client. That changes, that decreases, those metrics change as you go down to a product, which is like a $97 or $997 ebook, which is kind of no service at all, very low, very volume driven. You're just trying to sell as many of them as you can. There's normally a one-time engagement, maybe one or two upsells, relatively low lifetime value of a client. Those, and in the middle, we're sitting with consulting and done with you. The only difference that we have in consulting and done with you is what we would call, I'm not saying our terminology is right, it's just in the way we call it. Done with you is a group coaching model. If you're a group coach and you're trying to coach people in a group setting, if you're a consultant and you're working one-on-one, the metrics change just a little bit. So for purposes of this, everyone just focus on the done for you side. Our cost is going to be weighted heavier to team and less to client acquisition. Not because one's a bit more important or less important. That's just, we are a service-driven business, which means people are what makes us thrive. Okay. Right. So we're going to have a much heavier investment into team. And there we look at about 45% team cost and about 10% client acquisition cost. It makes complete sense. If you're charging, let's say, $1,500 a month for a client, and you have this client for 6 months, okay, you're going to make $9,000 from this client. Your lifetime value from that client is $9,000. What is 10% of $9,000? $900. Makes pretty good sense. Client acquisition cost of around $1,000 to get a client. You guys are the marketing experts. That's not unreasonable. That kind of makes a little bit of intuitive sense. So yes, the 10% may seem low, but we're calculating that on the lifetime value of the client. We're saying, well, if we can keep this client for 6 months, we can allocate $900 to acquire a new client.
Right.
That's not bad at all. It's very different if you're in this group coaching model where you get a one-time payment. You just get a one-time payment of $6,500. We're going to have to allocate more of that to client acquisition because of the nature of group models work. So we're looking at team costs about 45%, client acquisition costs about 10%, and then we can go even further and we can start to break down who are the people that we are trying to use that 45% for. So this is important. Our model, again, right or wrong, is completely irrelevant. This is the model we use. This is the perfect P&L. Fulfillment is all human resources, but all human resources, both client acquisition human resources, fulfillment resources, and operational resources. So what we mean by that is, if those are the 4 different buckets we can look into, we have people that perform operations in our business. Okay, in this case, CEO, COO, admin people, operational minded people, project managers, whatever it is. We'll have marketing people, someone running our ads, an agency running our ads, or CMO, or content creators, whatever they may be. We'll have salespeople, so salespeople doing sales, and then we'll have direct fulfillment. In the agency world, we're looking at account managers, media buyers, creative people, copywriters, whoever they may be. That's how we break down that 45%. That goes to all of this. That 10% is paid acquisition. It's the paid channel. So this 10% over here is the paid channel we would use to acquire clients. Yes, technically, these 2 roles are client acquisition. We did this for a particular reason. As you grow and scale your business, you want to try and lump all your human resources in one place from a management perspective. So we realized trying to take some of that out and put it into client acquisition was actually going to make our lives harder down the line. So we just said, okay, client acquisition is paid, all human resources sit into one bucket. And so that's the breakdown we would give for that 45%. About 8% to operations, 3% to our marketing, 10% to sales, 24% to direct fulfillment. I can take that 15% overheads and I can break them down even more, but that's going to be boring here. I have a percentage for every single line item in your business. I can now go to an MRI whenever I want. So I can start off from the beginning and I can say, hey, let's just look here. What is it at? Hey, it's at 55%, but it's at 28% overhead costs. Ding, 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 ding. We need to go work on overhead costs. Or, hey, it's sitting at 68% in our golden ratio. I go a little bit deeper and I say, actually, my client acquisition cost is 10%. That 58% is all sitting in team. Okay, so now I need to go even further. What is my team breakdown? Where am I spending my money? Oh, these are all fine, except direct fulfillment is sitting at 38%. I have a problem because it's costing me too much money to deliver my product. Now I need to make some changes. I need to either find some efficiencies in my team, or I need to change my pricing model. Because if my team is going to cost X and I divide that by 24%, so my team costs is $50,000 a month, whatever it is, divide that by 24%, that's going to give me my top line revenue goal that I need to aim for. Now I can see, oh, I'm $40,000, $50,000 a month off my top line goal. How do I fulfill that gap? Okay, now I can go make some decisions on how to do that. I can go face client acquisition. And so all the decisions that everyone is making every single day, they don't change. We're just layering on some financial metrics that say, well, let's guide you along these decisions so that you make the best possible decision. Not because without this, you would make the wrong decision, just you want to make the best possible decision. And with this, helps you do it.
I love this. This is so good.
I definitely even people are popping into my brain who can benefit from this. Just knowing all the agencies that we're working with and have worked with in the past is specifically who I'm thinking of. But this is awesome. So what are the timelines on this? We start using the perfect P&L. How do we sort of evaluate its progress and I guess money in the bank, right? But how do you get to that success level, Adam?
Yeah, great question. I'm going to answer it in two different ways. There's what we call growth cycles, is how you manage cash flow and how you manage your perfect P&L, which I'm going to talk about in a moment. It's very helpful. The other thing is just very practically, remember that it's a perfect P&L. It's a guideline. It's a roadmap. It's a blueprint. Just because you're not there, a lot of our businesses are a little bit different. We go and change little things based on their nuances and all that kind of stuff. That's okay. It's just a guideline. It will take time for you to get some traction in moving things around. What we advocate is once a week, you should be measuring it. Once a week, and measuring it just at the top level. You just have to measure this once a week. And this takes you longer than 10 minutes to measure. Then you've got some like fundamental accounting, financial problems that you need to go solve. Like you need to go structurally make sure that you have the right things in place, because this shouldn't take long to do. And maybe that's the case. Maybe you need that help. That's fine. But 10, 15 minutes, you look at it, you go, okay, we are great. We're fine. We're tracking in the right direction. Or we're starting to see things that we can start make decisions. The reason we say once a week is once a month gives you 24 opportunities a year. Once a week gives you 52.
Right.
I mean, which one would you take?
Right. Exactly.
I personally would take 52 if I can, but I wouldn't take 52 if it took me 4 hours each time.
Right.
So I realized I couldn't do that. If it's going to take me 4 hours each time, then I'm only going to do 24 times. Okay. So that's why the model is trying to be simplistic. It's trying to be as simplistic as possible. Not saying you shouldn't spend detailed time, but let's just be consistent with the measurement and then figure out where the detailed time goes.
And even to get you into a place where these numbers are just easily accessible and you know them and you're living them, like that's probably just best practice too, right?
Yeah. I mean, look, I'm not here to sell ourselves at all, but that's what an accounting firm does for you. That's what they come in and they say, hey, let's put the foundations in place. Without the foundations, you can't really do anything. Whether it is just running your business or whether it's managing it effectively, you need the foundation.
Right.
Okay, then there's this thing called growth cycles. So growth cycles are a real thing. So this is where people get hung up on the model in a way. Simple graph. The y-axis is pre-tax profit margin, here sitting at 30%, which is our perfect P&L. We were trying to get to 30% pre-tax profit, 15% breakdown between golden ratio and overheads. Our x-axis is revenue. So over time, we're generating revenue. So our goal isn't just to get to $50,000 a month in revenue, which is just an arbitrary goal. Our goal is to get to $50,000 at a 30% pre-tax profit number. So that's actually our goal. The perfect P&L is our goal number. Okay. I wish the world was like this. We all wish the world was like, okay, A to B, done, finished, let's go. We would all make it. The reality, it kind of looks like this. It's a much slower progression initially, but eventually you will get that kind of hockey stick to the point where you can reach that outcome. And what all that's happening is, as you're starting out, your profit margins are normally pretty low because you're investing heavily into client acquisition and fulfillment, and you haven't quite generated the revenue yet. You've spent the money on acquisition. You're waiting for the clients to come. You've spent your $900 on day one to get the clients, but they only paid you $1,500. That ratio is horrible. But month 4, 5, 6, that ratio is great. So we're waiting to get that ratio into play. And so we start to see the slow growth. But ideally, we're aiming for that profit margin. Then once we get there, we say, okay, well, let's go to the next point. Let's get to 100, to the next place. Again, we wish it was straight line. What we find is this is what your growth looks like. It's this kind of stepping stone effect of we're at a point and we get to the next point, and then now we're going to go to 100. It's very slow, and then eventually we'll get there. Okay. And what we're trying to manage is this growth phase of where initially our profit margins are very low and we're going, oh, this is horrible. Adam told me about this perfect P&L. He lied to me. I'm making no money. What's up with this? But what we're saying is, hey, we need time. We need time to lapse before we get to that top line revenue number that we want to then navigate this growth cycle.
And I think every entrepreneur can feel this wave.
Yeah.
It's real.
I mean, we live it not just financially, we live it emotionally, we live it in every aspect of entrepreneurial world. We live this up and down. Are we there yet? Oh, how long can I go? And so this kind of growth cycle effect. And to us, a big thing is cash flow, is how do you manage growth? If I want to go back here and say, hey, I want to grow my business. I want to invest money into client acquisition fulfillment. There's only one way to do it. I've got to take money and I've got to invest. I've got to go and pay for more acquisition. I've got to employ more people. So I need cash to do it. If I don't have cash, I can't do it. And so the whole purpose of understanding this growth cycle is to try and manage cash. If I'm not following the perfect P&L and I'm not getting to this 30% pre-tax profit number before I try and kick on, and I know this sounds very theoretical and doesn't always work in practice, but just stick with me. If I get to the 50, but I haven't quite got to the profit margin I want to get to, and I kick on, I could be experiencing this. I only got to 15% pre-tax. then I kicked on. That space over there, that's your risk profile, okay? That is your ability to grow, that growth cycle, oopsie, much bigger ability to grow there, and much lower ability to grow there. What happens here is your cash flow is much lower. You're trying to grow too fast. You're not accumulating enough cash. So you can see the difference here. We're accumulating half the amount of cash than we would be accumulating if we were getting to that full 30%, 60%, and cash flow kills us because now we just have less cash to navigate this time. And what happens in this growth phase is time is the killer. Time is the killer in a cash flow cycle, because you can tell me, hey, it'll take me 4 months to get to $100,000. What if it takes you 6? What if you hire that person, they turn out to be a muppet, you got to fire them? What if that first acquisition channel doesn't work and you have to split test for another 3 months to get the winner? Time is the killer. And so when we don't navigate the growth cycle properly and we try and just grow too fast, we're going to shorten the amount of time we have, which increases our risk, which means we run into cash flow problems. So our encouragement is, the reason why we want people to understand the perfect P&L is, before you grow and scale, make sure you've built the efficiency you need. So, okay, I'm at 50, go and measure your perfect P&L at 50. If you're not at these numbers, don't try and scale to 100. Take the next 1 month and get these numbers more aligned. Let's get some extra cash flow in the bank. Let's build these cash resources. Let's get 1 more month with another 15 grand in the bank. And now let's go to the next level, so we don't succumb to this model where we just have this lower level of growth and these massive cash flow issues. So that's how we navigate these two. They're real. Katie, I wish I had a better answer for you, that there's not this ebb and flow of growth. Like, we know that. It's just how you manage it. And again, we use the perfect P&L to manage it, because this tells us whether we should grow or not grow. If this is not where it is, if this is massively high, don't grow, work on efficiency.
I love that.
Right.
When it gets to that level, hey, now we can go grow. Now let's go and throw paraffin on the fire and let's just go and smash it out the lights. Great. But the perfect P&L kind of tells us where we should be and what we should be doing.
I love this.
Wow. This is like so
I feel like you've given so many secrets away. I'm like, oh my gosh.
No one needs a secret. If anyone can apply this and they don't need us, great. They can go win. Then entrepreneurs win. We all win.
Such high value for sure, Adam.
The one more thing I want to add is, the thing that trips most people up in this perfect P&L is how you pay yourself money as a business owner. Now, is that not why you run a business? So that you can earn money, okay? Yeah. You could have some higher power, higher desire that you want to do, great. But at the end of the day, we've got to make money. Otherwise, we're going to have to go and get it 9 to 5. How we pay ourselves money is extremely important. My encouragement to everyone is, if what you do every single day helps your business function and run, which it does. I'm saying that in a facetious way. We all know it does. You're not a shareholder. You're an entrepreneur. You work. How much you pay yourself falls part of fulfillment. If I go back to this thing, there's a little title there called CEO, who's probably what you are. You are part of the operational fulfillment of your business. So please don't go measure this and exclude how much you pay yourself, because you're just lying to yourself and to your business. Because, oh, great, I'm going to 30% profit margin. And then all of a sudden you go take your paycheck out and it's down to 5%. You're going to run the risk of this experience, which we try to avoid like the plague. We try to avoid that. Okay. You have to pay yourself properly. And even if you don't, even if you're an S Corp and you have a reasonable salary of $40,000 a year, that's fine. How much should you be earning? How much should you be paying yourself? Add that number hypothetically into your model. You're not worth $40,000 a year. No CEO that runs an entrepreneurship business is worth 40. They're worth way more. Put that number in. You're not going to like what you see initially. You're going to get a bit of a shock to the system. You're not going to like your profit margin, but that's real. That's reality. Build that business to be good, not this one that doesn't pay you because you don't want to be there.
That's advice.
That is the pro tip of the century. Like, definitely. I think that's super, super valuable, Adam, that people will, maybe take a step back, but then also even like when you do get there, like how good is it going to be, right?
Yeah. To me, the reverse engineering is what we do the most of, is reverse engineering. So we say to someone, how much money do you want to earn? Oh, I want to earn $150,000 in a year. Okay, well, I know if you're the CEO, you fall part of that operational piece. Okay, so it's you, it's someone doing ops, and it's a VA. Okay, let's add all those salaries together. Let's divide that by 8%. That's your new goal. You have to make X top line revenue to pay yourself $150,000 a year. that's golden. That's just a golden little nugget to go like, okay, now I know where I'm going. It may take me 6 months to get there, but if I don't have that, I'm just going to bundle along. I'm going to bounce around here trying to figure out life. You can reverse engineer these to give you tangible goals that you want to go and achieve.
Well, Adam, this has been amazing. Where can agencies reach out to you to get help actually executing all these things so they can get all their ratios in check?
Clever Profits, so www.cleverprofits.com. My email is adam@cleverprofits.com. If you want to email me, you can find me on Facebook. Adam Rundle is my name. Say what's up on Facebook and we can chat. Any of those, pretty easy. There's a YouTube channel, so you can go look at some more stuff. All the stuff is on YouTube in different dissected forms and ways. So if you're still on the fence and you feel like this is crazy, just go watch some of those. Again, not advocating that this is the only way to do things. This is just a way to run a business. We found a ton of success doing it. We found a ton of success having a guideline, having a rubric, having a scorecard, so that we can actually navigate making decisions. And it will be helpful to anyone, regardless of whether you want to change the percentages around. Just the model, just a model of some sort is so valuable. That's why a book like Profit First is so good, because it just makes intuitive sense.
Amazing. Well, thank you so much, Adam, for joining us on the show. It was a total blast. I'm going to rewatch this a number of times, but we really appreciate you coming on.
Thanks, Taylor. Thanks, Katie. Really appreciate it.
Thanks, Adam.
Cheers to happy clients.